Hello everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week, we're going to be talking about tax-free income using life insurance, part of our series on tax-advantaged income. Designed right, a non-modified endowment contract can generate tax-free retirement money without ERISA regulations and without taxing your Social Security benefits. And with me today and all this week is my special guest and co-host, Eric Palmer, National Director of our Advanced Sales for Brokers Alliance. Eric and I are going to walk you through all the tax items. We're going to debunk the myths of life insurance, and we're going to call out the critics who don't know what they're talking about, or at least are grossly misinformed. And remember, before moving forward with any of the strategies you hear on the show, always seek approval from your attorney, your CPA, and of course, if you're licensed securities, with your broker-dealer compliance department. Well, welcome everyone. I'm Steve Savant, the whiz of the biz, and with me today is Eric Palmer, National Director of Advanced Sales here at Brokers Alliance. Welcome to the show, Eric.
Glad to be here.
We're broadcasting live from Fountain Hills, Arizona, home of America's largest fountain, to a national audience of financial professionals, and we want to welcome to our show. This is going to be a hot show all this week, I have to say, Eric.
I agree.
Tax-free. People are talking about taxes all in the news. But a little heads up, before I do that, let me do a little housekeeping before we get going. I just want you to know that the Business Insurance Zone is a Bravo broadcast initiative from the National Insurance Clearinghouse. That's our marketing arm here at Brokers Alliance, and we're distributing always in the beautiful resolution of HD 1080p all over YouTube, Vimeo, Facebook, Twitter, LinkedIn, and our on-demand section at brokersalliance.com. The show's email address, if you want to write us, is thebiz@brokersalliance.com, and you can always call us toll-free 1-800-290-7226, extension 147 for any quotes or questions you have on life insurance, annuities, DI, long-term care, and group pension. Right. I wanted to mention one thing, well, just a little side note here. We're recording in the month of November. It's LTC month.
Right.
So if you haven't been thinking about long-term care standalone policies, or if you haven't been thinking about linked benefit annuities with LTC or linked benefit life insurance, this is a good time to think about that.
Absolutely.
Well, Eric, let's get into it. This part of our segment today, we're going to be dealing in taxes. And again, I just want you to know, heads up, I'm not an attorney or a CPA. Before moving forward to anything we talk about, always check in with your CPA. But I have to tell you, 90% of the grief that I hear on cable television and on radio is so misinformed and out there. And I realize that there are a lot of people that don't sell what we're going to talk about right. And if you don't do it right, it can be very hurtful to the client.
Absolutely.
So,
well, it's becoming more popular. Everybody's looking at alternatives to just paying ordinary income tax and trying to minimize the amount of money that's exposed to ordinary income tax. So once they get to retirement, of course, they have the most amount of dollars and cents in their hands. And so with all the strategies that are out there are mistakes that are being made, and we hope to address a lot of that stuff on this show and the next couple of shows that we do, because if you're out there selling these alternative tax concepts, you're exposing yourself potentially to doing it wrong. And that's where things could go, of course, wrong for the client.
Yeah, you know, when we think about it, if you do if you actually follow our prescription for the whole week, we're going to talk about a lot of things, setting taxes first, you will not experience any ordinary income tax. Now, let me just say, is the policy been designed as a non-MEC TAMRA compliant contract? It's issued that way.
Right.
It has to be kept in force for the life of the client. And by the way, heads up, we'll get into this a little bit too. Is the maturity date going to outlive the client's issue, his age? Exactly. That's another issue. But you shouldn't experience any ordinary income tax unless your maturity date had a problem. Now, let's just talk about that for a second, get it out of the way. If you had a contract where it actually matured, all policy loans would become due on the date that it matures.
Right.
So it's a taxable event, ordinary income tax, on constructive receipt of all policy loans. But heads up, most clients don't pay the interest.
Right.
And even with a spread loan or a wash loan, there's still some small accrual charge, even on a wash loan.
That's absolutely right. And if you think about it, a lot of the products that are being used right now are based on the index returns. And so if you actually have a floor in an index product, and we've talked about this in some of our other shows, of 0 or even 2%, your cost of insurance is going to weigh in there and potentially provide negative returns. Your client's anticipation is to take income. You sold it that way. And whatever illustration you use in the point of sale process is what's going to be stuck in your client's mind. So if they're expecting $50,000 of income, they're going to take $50,000 at least for the first several years. If the rate of return wasn't what you showed on that product, that thing could lapse, it could fall apart, and at that point your client's going to be stuck with a heavy tax bill, and that's what we're talking about here.
Yeah, it's really a big concern. Maturity dates, your ability to no lapse during distribution. We're trying to construct and always design our illustrations, our proposals, so that they always have the least amount of expense loads, because we want this thing to run for the life of the client.
Right.
If the maturity date not only is, if it has a problem where we can't extend it because the client or the contract doesn't permit it, all policy fees, all policy loans become taxable event in the year that occurs, and all the interest that was being paid by the interior cash values are being cannibalized. They also become due, and that's money we never even took constructive receipt of.
Right.
So it's an issue. It's an issue.
And it can be a large issue. We've had some stories come to light where clients have been stuck with several $100,000 worth of taxes due, and at that point, of course, you know, the advisor is maybe not even in the picture anymore. So you know, the families get affected there. The advisor, if they're still in the picture, obviously gets affected there. And one way to mitigate against that is in not just using Brokers Alliance, obviously, for our expertise in helping design the most appropriate structure of the policy for your client, but also remembering during the point of sale process, don't rely on selling the 8% returns in the products. Focus in on the advantages to life insurance in general, and we'll address a lot of those in these next few shows. But if you focus in on those benefits, then they're not going to be so reliant on that rate of return.
Well, think about it. If we don't have to worry about phantom income tax on policy loans because we either chose the right carrier with the right maturity date, or I like these new maturity date language where it says life of the client, or I'm sorry, life of the insured. So, or the extension privilege. Just remember what's in the contract. It's not what's proposed, it's not what's illustrated, it's what's in the contract. There's a difference between current company practice and contractual guarantee, and we want to kind of lay that out best we can. Now, heads up, this is a strange one. I was teaching at the CPA Society here in Arizona one day, and I was talking about the tax-free issues of life insurance, and somebody stood up and said to me, Steve, isn't life insurance a tax preference item under the code? And I thought that was the most curious thing I've ever heard in my life. And I started thinking, trying to remember, well, is there such a thing? And I said, you know, in a death benefit scenario, in a C Corp, I remember that if proceeds come in to the corporation, it could, remember there's a lot of mitigating circumstances here, it could actually trigger the corporate AMT tax on the death benefit. But not the way we're talking about taking money out in a distribution. Now, the reason I bring that up is because that's a huge advantage, and I just want to make sure that all my fiduciary friends out there, CPAs and attorneys and trust officers, understand that, yes, we are a tax preference item under a death benefit owned by a corp. But we're not talking about that here. And remember, 99% of everything we're talking about on life insurance ownership is going to be non-qualified anyways.
Absolutely.
So we're not going to be talking about issues like that most of the time. Not corporately owned, not ERISA owned, so we're okay on that. What, not only are we talking about no AMT, and remember, the heads up, all income, I mean, you know, retirement income coming out of your 401k, that's all going to be calculated for Social Security benefits. Even your, some mutual funds, this is so hard for me to think about, but some municipal funds could be subject to the AMT, and that income could also be calculated on your provisional income test for Social Security. And the thing that really blows my mind, and I have to say, this is a new one for me, it's called the capital gain tax trap. Now, I mentioned this on our white paper that's out on the, website, and you can get that at www.maxretirement.com. Now, the reason I bring this up is because when I'm looking at all the advantages that life insurance has, and it doesn't trigger any other ancillary taxation, like I'm using Social Security, I want to use a new word, Eric, all in. Not only is it tax-free, but my income doesn't interfere with other investments. Capital gains. I love capital gains on mutual funds. I pay the 15% capital gain. I love that present taxation. However, when I look at the actual gain, the whole gain goes over to my provisional income test to test whether my Social Security benefits, that's the tax trap. I'm getting 15%. Oh my goodness, that could actually cost my Social Security at ordinary income rates to be taxed again. So when I start looking at the all-in, life insurance, if it's done correctly, the tax benefits are huge.
Well, and that kind of bleeds into what I had said before. You know, you don't really need to focus on those high rate of returns in the policies to sell the highest amount of income possible. What we have to take a look at is if your clients are sitting with money in 401ks or they're using non-qualified assets to produce income for themselves, the after-tax effect is what you want to analyze for your client. And you don't have to be a tax professional to do that. Just ask them what their ordinary income percentage is, crunch some numbers, make sure you let them know that you're not a tax advisor as well. But that's the after all-in dollar that's going to end up in their hands. And when you take a look at that that against a very a conservative rate of return in a life insurance policy, you can produce that same type of income. So it is all about that at the end of the day, how much money is actually spendable by me in retirement. And when you look at life insurance, it doesn't take an 8% return to accomplish that. Really, we can get away with about a 4.5, which is what we're seeing right now in most current assumption products.
Yeah, if you're really thinking about the all-in or the net spendable money, as you've said, and I think that's where you have to go. All our consumers are thinking this way.
Right.
So when I think about this, I'm looking at the tax advantages, and there's a plethora, a menu of tax advantages, tax favoredness, and if it's done right, we won't fall into the cap gain trap. Right. We won't have the AMT, the alternative minimum. Now when we're talking about looking at contracts, and I'm always saying, well, should I do a 401k? Well, if my employer matches it, I'm doing it all day long.
Absolutely.
You have to do the qualified plan.
Up to the match, absolutely, because that's essentially not just paying the taxes for you that you're going to get at the end of the day, but it's also adding a little bit extra because you're obviously not paying 50% taxes, at least not yet anyway. So if you're getting a match on the 401k, I always say absolutely get yourself right up to that match. But what do you do with the rest? And you can only put so much money into an IRA. So what do you do with the rest? And a lot of people today recognize the fact that they've got to create their own pension. So they're already thinking about a leftover sum of money that they need to park somewhere.
Back in the day, when I was a young man, I have to say, we used to say, put money in a 401k and invest the difference or the tax savings in an annuity. Right. So that you had deferral, you were letting Uncle Sam pick up the annuity. It was great. Nobody does it. We always say, remember, we have mantras in our business that nobody ever obeys. Buy term, invest the difference, but nobody does. Right? Go and buy in 401k, whatever the tax savings is, put it into another deferred product like an annuity, but nobody does. So I can't go on the idealism of what people should do. I have to go on the behavior of my client. And so there's a difference here. Right. And remember, everything we're talking about is taxation. So when I'm looking at taxes, I'm looking at the all-in. I want to see the net spendable. Maybe that's because that should become our new landing page, our netspendableincome.com, because that, to me, is the play here.
Absolutely, I agree.
Well, when we come back, we're going to talk a little bit more, bring up a few ERISA issues that I think you're going to find really huge. Remember, you can download the white paper and the tax-free series at www.maxretirementreport.com, as well as our tax advantage series at www.brokersalliance.com/tax advantage products. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. We'll be right back with more about tax-free income from life insurance. I just want to take a little moment between segments. If you're looking for new ways to expand your practice, tax-advantaged income strategies could be a game changer for your business. With everyone projected to live longer and taxes expected to increase, tax-advantaged income strategies for retirement will become the most important component for savers as well as investors. At Brokers Alliance, we've designed tax-advantaged income strategies using annuities and life insurance. From annuity income riders to medically underwritten single premium immediate annuities, from participating whole life to current assumption or indexed UL, we have the concepts the consumer is looking for. These tax-advantaged income strategies can generate more net spendable cash in your client's pocket than conventional concepts currently used by professional planners. You can view and download the white paper and our tax-free video series at www.maxretirementreport.com, as well as the tax advantage series at www.brokersalliance.com/tax advantage products. That's tax advantage products at the end. Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and interviewer extraordinaire. And of course, I'm with Eric Palmer, director of our National Advanced Sales Department. And Eric, welcome back. We're talking about tax-free money.
It's a good subject.
I love this subject. I mean, think about it. When we're talking about, I'm a patriot. I want to pay whatever my due is. But if the government gives me ideas to play in, I want to play in that. I want to max my take-home pay. Right. That's the bottom line, isn't it? Maxing our take-home pay.
Max your take-home and make it last your lifetime. You know, we're living longer. 35 years of retirement is something that we have to anticipate planning for, if not even longer. So it's a three-legged stool. We're not saying that put all your money into life insurance or put all your money into annuities, but we're certainly saying that those are two crucial components of the lifetime guaranteed income mentality out there. And the baby boomers, the one thing that we have to say about them, other than being the largest retirement population out there, is that they are smart and that they know how to use the internet.
Well, thank you, Eric.
Yeah, they know how to use the internet. They know how to look up information and research things. And so they're more in tune to the fact that they have a problem. They need to address it. They're just looking for the ultimate solution, and that's where, as advisors, we have a chance to put life insurance and annuities in front of them.
Before we go any farther in our second part of our segment, I want to read you, just for our own E&O purposes, and our caveats, disclosures, and disclaimers. I just want to bring up this one thing. It's on our SEO words when you go out to our video, but I just want to say it on the air as well. Remember our caveat on tax-free income using life insurance. The life insurance policy must be designed as a non-modified endowment contract. The contract has to be kept in force for the life of the insured. If the maturity date of the contract does not contain a maturity date extension provision, the client should be notified in writing in the application and have it initialized. During distributions, any withdrawals of basis or policy loans of gain must comply with the force-out rule, guideline annual, and guideline single, and/or the cash value accumulation test. Now, I know that sounds like a big caveat, but I'm trying to cover everything we want to talk about.
Right.
And remember, when you call us in, when you want us to do this, we're going to be complying across the board with these regs.
Right.
Now, one of the things we talk about, we mentioned in the first segment, is trying to compare 401ks to a life insurance contract. If your employer is matching, we're doing the match. We're not doing life insurance. We're going to do, but once we get over the line, or maybe now today it's a little tougher. Employers are tight for money. They're not matching anymore like they used to, Eric. So now we're running into issues like, wow, okay, well, I might have to look at that. But remember, one of the key things about life insurance is we're not under ERISA. So talk a little bit about the 59.5 rule and the 70.5 rule, because that's ERISA and we're not under that.
Well, I think that's one of the biggest advantages there. And a lot of times we run into a problem when we're just looking at annuities as retirement alternatives, because it's becoming more common today that people will retire prior to age 59.5. So let's start there. If you're looking to take an income out of a retirement account prior to age 59.5, the IRS is going to penalize you for that. And the reason being is that those accounts are designed with our tax deferral statuses to provide you a retirement-based account. And at this point, retirement is set at a higher age, 59.5. So we've come across situations all the time where the 51, 52, 53-year-olds looking to start taking out income. Now, when you have annuities, one of the issues that you run into is that you have to use what is called a 72T or a 72Q to take a systematic form of withdrawal. And there's some guidelines you have to follow. So a lot of times you can't take as much money as you want, or you have to remain on a certain payment plan for a set number of years, or until you have reached the age of 59.5. And so that doesn't always work with the plan. It kind of fits you right into a box. And so a lot of times people aren't attracted to that. So the life insurance side of things becomes quite attractive, because there is not a penalty for a 59.5 or a pre-59.5 withdrawal. So if you're 52 years old, you've been putting money aside into this life insurance contract for, say, 10 years, you might have some cash value. You can take a loan against that cash value tax-free, and you're not paying any sort of penalty to the IRS. So that addresses a major issue. And a lot of times I know there's a lot of annuity producers, they don't sell life insurance, and a lot of times as that's one of my fortes, being annuities, I always tell people, listen, I always put life insurance on the table too, because it addresses that specific issue.
Yeah, when you think about it, it's not only tax-free distributions we're talking about in this segment of the show, but heads up, as far as ERISA goes, if I have qualified plans, and as a baby boomer, I certainly do, and I have money in my qualified plan, if the longer I can defer it, the better it is. So if I can wait till I'm forced by the RMDs, required minimum distributions, at 70.5, what would I take out before? I could take out my life insurance proceeds, if I do it correctly, tax-free. My Social Security then would not get dinged. There would be no taxation on that, unless you had other investments that I'm not aware of. I'm just saying based on what I'm talking about. That means that from the time I retire, let's say 60 or 55 even, like you said, I can get into this money. I can't get my Social Security yet until 62, but let's just say if I wanted to, I could use my life insurance in combination of my Social Security, and I wouldn't have any taxable event until I had to play with my RMDs later on. So I'm stalling, giving my qualified plan a lot longer time to accumulate, and I'm using my life insurance up front tax-free in concert with Social Security, which then should be tax-free.
Well, and that brings up a couple of good opportunities too as advisors out there. We're always looking for that what do we market, what do we say, what do we go after? And one of the hardest things to do right now is hedge for inflation. There's always a cost factor when using insurance products or any other type of product out there, because if you're laddering, you're using more investments, there's potentially more charges you're incurring. So both sides of the coin, you're going to end up adding to the plate in terms of what it's going to cost you to hedge against inflation. But you can naturally ladder for inflation in combination of things with life insurance, for example. And there's certain strategies that we actually have some materials on where, for example, Social Security, there's a window of time, and we have certain products that will help attribute to this, that you can delay, if you will, taking your Social Security until you've maxed out the level of Social Security up to the age that it maxes out the payment for you. In lieu of that, you're still going to need a stream of income because you will have retired. So we can use the combination of an actual annuity product that we carry and a life insurance contract to basically maximize what Social Security is going to provide for you. In the meantime, provide something that you would expect Social Security to pay you at, say, age 65 if you were going to trigger it then, and create that natural step up in income once we've actually triggered the Social Security event. Same thing with RMDs. We're forced to take them at some point, but if you can push the qualified money far enough down the chain, you potentially have a lower taxation at that point because your income is different, obviously, at age 70 and a half. And also what we've done is we've put you in a position to potentially create an additional layer of income to continue to fund other contracts, long-term care. There's a slew of things that you can do with that required minimum distribution at that point, or it could be the final leg of the tier, if you will, for that inflation buffer. So we have specific strategies to address both the issue of maxing out Social Security and utilizing your RMD to its fullest effect.
I think that's a new tactic from a retirement modeling point of view. If we're going to use qualified plans, annuities, life insurance, and capital gain mutual funds, trying to make this all work in the best tax advantage I can, it's really important, when do I take out these distributions?
Right.
Because that's going to affect my net take-home pay.
Right. Establish the timeline.
That's a huge issue. Listen, if you're saying, I don't know how to determine my client's ordinary income tax bracket, if you call us at 1-800-290-7226, extension 147, and ask for we have a complete grid where you can actually calculate your client's ordinary income tax. And heads up, we even have a single page, and it's actually easy to use, a Social Security provisional income test. It's a single sheet. It will be able to put everything on there, including preference items that could trigger AMT issues. All those things are already on there, so you can calculate the two-step test to see whether your Social Security benefits are going to get taxed or not. So if you want that, we'll send that to you completely free.
And one of the hardest things to do is we're talking about a few different legs of the race here. We've got a lot of different products that are used in combination to achieve that kind of a strategy. We have a software program that we provide access to absolutely free to our advisors. It's called Plan for Life. If you aren't already using something to illustrate the laddering approach and the approach to spread out the time in which you take these certain income events, the software can actually provide that for you, and it puts together a nice 24-page presentation for the client. So if you need something like that,
is that a cost?
There's no cost to the advisor. What we obviously look for is the relationship, and so it's one of the advantages to working with Brokers Alliances. We can arm you with those types of tools as well, because a lot of times your client needs to visualize where you're going with the laddering steps, and if they see it on paper, they see that the income lasts, it meets their goals, it's easier for you to make the sale.
Actually, when we're talking about people that are under 60, we're looking at the laddering approach of using combination annuities, different types of annuities, but for our long haul hold position, we're looking at life insurance for like 15 years and farther out. The longer I can hold life insurance, the better I can accumulate, and some expense loads, we're going to get in that tomorrow's show, actually drop off after 10 years, after 15 years. Surrender charges are gone. I love all that.
Right.
So if you can hold it, remember, it depends upon, and even if you're a little older and you say, gee, I'm kind of older for that, you might be able to, under certain justification rules of life insurance, use a surrogate insured. It doesn't actually necessarily have to be on you. It could be on this surrogate insured or a family member.
Right, and we've seen some survivorship cash value accumulation products that have worked well in certain combinations too, where there's a large gap in age between the two spouses, because there again we're able to leverage some of the lower costs in the contract. But like you said, one of the most important things to do is remember that life insurance carries a cost. and that there are points down the road where those costs will drop off, but that makes it a long hold position. We get asked quite often to illustrate 5-year income scenarios, 6-year income scenarios, and it doesn't work.
No.
And that's because there's an inherent cost in life insurance. There's a premium load. There's a lot of moving parts. It's at least a 10, but we're comfortable saying 15 years to make this thing really work for you. And there's annuities you can use up front to accommodate the money in between.
Yeah, in fact, when you think about it, Eric and I are mortality mechanics. I mean, we're sitting there trying to figure out what's the best way to position our clients to do tax advantage products so that I can take the net proceeds, the best, most net spendable take-home pay. I want to know what's going to be in my hand. What can I actually spend? I was actually talking about this to one of my children when I said to them, he says, well, how much will this truck cost? And it was a used car. And I said, well, it cost $5,000, but it cost me $7,900. And he goes, why did it cost you $7,900? Because I had to make $7,900, pay my tax bill, then I had that in my hand.
Right.
See, people think, the normal consumer thinks like this. Anytime we can deliver tax-advantaged or tax-favored investing, we need to look at it, because that's going to be the play. And you know, the old mantra was, when I retire, my bracket's going to be lower.
Right.
I don't know about that anymore.
Well, I think that there's also an idea that the markets are going to return, and then I'm going to see a 5% or better average rate of return. Now the market, I talk about illustration software a lot, but I know that it's helpful to have for point of sale, and that's what we're trying to do here, is arm you guys with point of sale materials. Lincoln Financial, I'll drop a line for Lincoln quickly, but they have a tool to actually compare life insurance against your client's brokerage accounts, and it'll show those tax advantages. So take hold of that and use it, because
you can get that again, 1-800-290-7226 extension 147. Remember, you can hop out at www.maxretirementreport.com and pick up the 5 series that we're doing now and the white paper. It's huge, and I think this could be a big game changer for your practice. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226 extension 147.